All right, so we had a weak close to the week. That's not surprising. What is surprising is on Mondays we usually gap to the upside and then rally to the upside, and that was not the case today. Today we broke, I think it was 10 Mondays in a row. We broke quite the streak of having positive Mondays, and there were some negative signs today. So in today's preview of the full version of the market outlook video, I break down some of those signs that showed up and what we're going to be watching for the rest of this really important week. So let's go ahead and get started. Today is Monday, November 17th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, click this link up here in the top right corner of your screen. That takes you to this page. This is our full version of our Market Outlook video, or blog post, excuse me. It's free for all of our basic subscribers at Market Scholars. When you click that link, this is what the page will actually look like. You have to log, if you're already logged a member, you can just log in right here and it will take you straight there, or you can just log in up here at the top. But if you're not a member, click this join free, unlock this post. It will take you to this page and just join for free. Again, you get instant access. There's no commitment. There's no cost, no credit card required. And you get access again to all of our, like if you go to Market Outlook Video Archives, all of our blog posts, and they include this video that you're watching right now. And then on Fridays, with the basic subscription, you also get the full version of the Market Outlook for free every Friday. That's usually available for our foundation members, but our basic subscribers get them on Fridays for free. All right, let's start off looking at the market forecast on the S&P 500. You can see we have a red line, so we're below the moving average by only about 1%, but it's been flat enough. We've been converging for so long. So it's been flattening, and now it's been flat enough, and we're below it enough that it's actually turned lower. You can see we've been below. It's not like we've never been below 1%. When we got below by 1% over here, it was still yellow, right? So it's just a matter of how fast is it moving? How much has it been converging before it hits and drops below the moving average by this much? And it's been pretty sideways. The intermediate line's down. It's out of bullish territory again. The near-term line, the momentum line, however, still not showing that strong of a bearish pattern. So if there is one little positive about today and increasing the likelihood of another, at the very least, weak bounce, is that we don't really have strong short-term sentiment, which means we're not closing at the lows, not only on one day, but on successive days. We're closing near the lows, but we're getting enough of a bounce into the close that is keeping short-term sentiment positive. For an example, if I were to correct today's bar and put the close at the low, this is what it does to short-term sentiment, and that's a lot more bearish. So taking that out, you can see brings them both up just a little. That much of a bounce off the lows keeps us from being strongly bearish on the S&P. And then the full version of the market outlook, we take a deep dive into all the other indexes as well. One of the other indexes that's really kind of struggling lately is the Russell 2000, and it's been kind of more of a leading index. Right? It generally breaks to 50 and starts working its way to the 200-day moving average faster. You can see that happen back here in December of 2024. Back in December of 2024, the S&P was just kind of flirting with, but never even came close to the 200-week. By the time it did hit the 200-week in March, early March, 200-day, moving average, and broke through it. By early March, the Russell 2000 was well below the 200-day moving average. So, and that's the case right now. We are well below the 50-day. The 8 and 17-day are below the 50-day. All the moving averages here are falling, except for the 200-day, and we're moving towards. Again, there's some strong support with the point of control, but the MACD. We are clearly in intermediate decline on the Russell, and would suggest that's probably where we're going to go on the S&P. The S&P, when you look at the Qs relative to the Russell, we're okay. Like, we're still near highs. In fact, we went up today. But if you look at the S&P relative to the equal weighted index, it also went up. And that's not something you would expect on a down day, because usually the S&P underperforms. That's 90% correlated. So the fact that the S&P went up on a day that the ratio, went up on the day that the S&P went down is a little telling, and it shows that the selling was not necessarily mega cap related, or at least dominated by mega cap. It was more broad. It was a lot more broad selling there, and one of the big canaries in the coal mine, so to speak, is the smaller banks, the regional banks. They came down to the 200-day moving average right before October expiration. We bounced right off of it, and now after a lower high point and a failure at the 50 and 30-day, we are breaking the 200 days. So potentially now moving into correction level territory with the MACD and stochastics coming off of bearish peaks. You can see the market forecasts for the banking sector. We've been in bearish decline already. We got a failure with this bear tag, which again, corrections end up with that failure with some kind of bear tag or close to it. And then now the intermediate line's back below market sentiment. It's not the strongest short-term sentiment, but still a rollover from a bear tag usually means that we're headed towards, especially when we're breaking the 200-day, we're headed towards a correction in that. And that, of course, had an impact on the VIX. If you take a look at the VIX here, the VIX was up over 20, up over 95.95% relative to the VIX 3M. And the VVIX is well up to 110. Remember, the biggest moves in the VIX occur when the VVIX closes above 110. So, again, we're not even above the 100% mark yet, which is usually what happens on intermediate declines. So, we are susceptible. And when you look at the VIX relative to its own averages, it's clearly above the 200-day. And again, this is the area where either we peak and roll back over, or we're susceptible to this kind of move, right? Again, whether that was a correction washout stage, so we're not going to get up into the 50s, but even this kind of move where we get closer to the high 20s and low 30s, those kind of moves occur after we've already kind of made this kind of break above the 200 with the VVIX above 110. Finally, the other big thing that happened today, which we haven't seen in a while, is that we dropped below the minus 35 mark and really got down to minus 50. What really we broke down, what we haven't seen for a while, is the summation index dropped below zero. So this is the first day that we've been below zero since we came off the lows, right? And again, usually when you cross below zero, that's a sign of intermediate. I mean, usually intermediate declines don't even get to zero. This one didn't, that one didn't, this one did, and then of course it led the bearish peak here led to a correction. But again, breaking zero usually is if not in pullback mode, is suggestive of more of a potentially deeper pullback mode, given how poor the breadth is. So you can kind of see not only is the S&P itself rolling over, but there are some cracks that are starting to show from a broader scale that suggests more volatility in the near future. And that's our market outlook preview for today. As always, if you'd like the full version of the Market Outlook video every day of the week, not just on Fridays, remember our free subscribers at Market Scholars get access to the full version every Friday for free. But if you want access to it every day, including the trades, including the Market Outlook Live, where we place the trade in real time before the market closes, where we manage all the trades all the way to the time that we close them and talk about when we close them and why. And then you also get access to our trade tracker, where we track the results of all the trades. You get access to all of that for just $29 a month. That's our foundation tier. This link right here will take you to subscribe. Again, $29 a month. There's no commitment. You can cancel at any time. And that gives you access to our most basic tier at marketscholars.com. Again, thank you very much for watching. Follow me at DavidSettle42 on Twitter for more content between the videos. You can also subscribe to our YouTube channel down here or with this icon over here. Click the thumbs up icon down there to like our video, comment, and share the video with anybody that you think would be interested in it. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.